Hong Kong and I loved it. But I'm going to stay in London. But it's right that three of my executives, particularly, they're the three heads of some of our global businesses, wealth and personal banking, global banking and commercial banking, are moving to Hong Kong. It's great for them. They get to experience that growth opportunity. You know, Asia is a phenomenal growth opportunity, not just in Asia, but for our clients as they expand globally. And it's great they're experiencing that. And I want them close to the opportunity and close to the growth. But I'm staying in London.
What are your expansion plans in China? Are you hiring?
Yes, we're hiring. We've announced the commitment. We got an initiative called Pinnacle. The plans there are to hire 3,000 extra wealth managers over the next 3 to 4 years. We've already hired 600 of those in the first 9 months of the program. We're on track for our target for hiring this year. And the initiative's going really well. It's meeting business case expectations.
When we hear China say that actually they want to have a fair society, what does that mean for wealth creation? And what does it mean for your pivot and your focus on China wealth?
Well, let me talk about wealth creation from a China concept. I mean, if you think about the number of cities in China that have over 1 million urban population, there are different statistics out there, but it's certainly around the 75 to 90 mark. Now, many of those cities have gone through urbanisation over the past decade to 15 years, and they're going through GDP per capita growth. And we're starting to see those cities turn into strong consumption markets. And as they develop consumption appetite, typically when they get to GDP in the double digit, $10 to $12 to $13,000 per head, that's when they start to think about wealth products, insurance, wealth management, investment products. And that's where I think the huge opportunity is. And by the way, urbanisation hasn't finished. There's still more urbanisation to come. So I think we're on a long transformation program within China where the creation of wealth, and it's about definition of wealth, it's not super wealth just, it's wealth for the middle class and it's wealth for the urbanisation that's taken place. That's why I think everyone's interested in China as an opportunity for wealth. And don't just think about wealth in China as the super rich. It's also wealth for everybody, and it can be as simple as an insurance policy.
So with the latest crackdowns and extra regulation, you don't really feel like it will veer you off course?
No, I still think it's an important market opportunity, it's an important market need to serve, and it's not going to change our investment plans.
Do you look at China in terms of a 3-year plan, a 5-year plan, or is it more nimble given some of the changes we've seen?
Oh no, you really got to look at China as a minimum as a 5-year plan, and you've got to really, in that 5 years, be laying the foundation stones for the next 5 after that. You don't look at China on a 1 or 2 year or 3 year operating cycle.
Talk to me about Hong Kong, some of the laws that, the sanctions law. If it comes through, what does it mean for the financial sector?
Listen, as an international bank, as I said, we've been around for 156 years. One of the jobs of an international bank is to comply with complex laws and sanctions laws wherever they're implemented. And that complexity has increased, but we'll navigate that as we have done so far, and we'll continue to do so going forward. But you have to stay close. You have to stay close with your clients and with the regulators to understand their requirements and to navigate those complexities. But it's certainly a complex situation at the moment.
Watch Bloomberg Surveillance to learn how to look at markets, how to look at trends, and how to look younger.
What do you think, John? Botox, or do I really need to get something done?
I think, Tom, if we just change the style up a little bit.
You think so?
Yeah,
you
drop
great.
the bow tie. Drop the bow tie.
What, skinny tie?
Yeah. I always say, this is my line, whenever anyone in America has a go at me about a skinny tie. The older you get, the wider it gets.
Oh, really?
Until it becomes a bow tie.
This is a bow tie.
Until it becomes so fat, you just sort of...
Have any mistakes you've made or failures that you can talk about so that people could feel you're not just a superhuman?
People ask that question as if the only challenge is at work. Challenges come in a lot of different packages.
How much do you spend actually thinking about sustainability? We've seen demand for sustainable products increase.
Huge.
But also a lot of questions about whether, financial institutions are greenwashing.
No, it's a huge topic, and I think it became even more urgent through COVID. I think COVID was the wake-up call for so many people, me included, on how fragile the world is to a natural event. And I think the pace of change, the dialogue that's taking place today relative to 18 months ago is much greater on sustainability. So I think it's both a huge opportunity whilst also a huge risk to manage. And by opportunity, let me just clarify what I mean by that. In our 156-year history, we've seen the industrial landscape change dramatically. The commercial landscape, it's unrecognisable. I think in the next 10 years, we're going to see a similar transformation take place in the industrial, technological, and commercial landscape. Why? There are industries today that are carbon heavy. They will need to transform their technology base, their business models, to be fit for a net zero world of 2050. That creates huge opportunity. There's also risk in that transformation. And what I want HSBC to be is at the centre of that transformation, leading that change. And I quantified what that meant back in October of last year when we published our sustainability strategy. I believed, through all the analysis we've done for HSBC, there is an opportunity to finance that transition, to help those customers build new business models. I quantified that at somewhere between 750 billion and $1 trillion over the next 10 years of either investment that's needed to be funded on our balance sheet or through capital markets.
But often we're not talking about the same language. So there's concern that actually, certain funds, certain banks are overstating some of the sustainability impact.
Yeah.
So how do you avoid that?
And that's where we've got to take the reporting. You've got to have transparent and consistent reporting so that the words financing the transition are not just a marketing strapline or a strategic strapline. That people, stakeholders, investors, regulators can decompose that and say, I understand what your balance sheet looks like today. I understand the targets you're setting to work with your clients to finance the transition. And I understand the progress reports that you're issuing every 6 and 12 months through your report and accounts. And in that regard, we're developing, as other banks are, our own reporting methodologies, but we're trying to do it in a way that's consistent. So I also chair a task force of like-minded banks, about 11 of us, who are trying to set a framework of disclosure that if you use the phrase finance the transition or achieve net zero, this is what it means. And there is an architecture of reporting that we put in place that allows the readers of our reports to understand how we're doing that.
How do you expect the return to the office to go?
Listen, my own view on the return to the office is it would be a waste if we didn't learn from the last 18 months. If I think about the future, do I want the future to be the way it was pre-COVID on working environment? And let me explain that in more detail. over 200,000 of my colleagues, 90% of them work from home. Not everyone could, because they had to work in branches or work on trading floors. But a lot work from home. Now, I trusted them last year to run the bank globally in 60 countries, and they did a fantastic job. I'm not going to turn around to them now that COVID's over and say, guys, I no longer trust you to work from home. You know, not all jobs can be done from home. I'm a realist. There are certain roles that have to be performed in premises. Also, offices will always have a place, because offices are great environments for learning, for innovation, for collaboration, and from team building. But I don't have to translate that into a statement that says, right, now work in the office 5 days a week doing emails and VCs, when I've just trusted them to do things at home for the last 18 months. So I'm learning, but if you want a label, I'm probably more inclined towards the hybrid model for certain roles.
What segments of banking do you see more talent wars? So I feel like every day we have a story about junior bankers being paid $110,000, $120,000. Chinese quants apparently paying them $300,000.
Yeah, there is clearly a very hot market at the moment, particularly in investment banking, at all levels, not just the junior levels. There's a very hot market at the moment in global markets, in the trading businesses. But you know, they go through phases. We're very fortunate in that we have some really top quality individuals that are working for us, but competition for talent is the same as competition for customers. It has always existed and always will.
Do you have to increase your prices? Your pay?
Pay. I mean, we've always got to adjust. We want to make sure we're paying to market, that we're competitive, and that we're keeping our talent. So we monitor the market pay levels very closely.
Will you or your executives travel less post-pandemic?
Yes, undoubtedly. Again, it's part of the learning curve. It would be a shame if we all went back to the way it was, where we were flying around the world for one-day trips here and two-day trips there. So my expectation is I will probably do fewer, longer trips. My expectation is that will translate into probably a reduction in our travel budget by around about 50%.
Which is quite,
for the bank as a whole.
Quite impressive.
Yes, that's my expectation. Now, at the moment, we're nowhere near spending the balance of the 50%, you know, because there's still so many travel restrictions. But we've learned to live and operate in a very different way. Video conferences worked. You know, I remember one day sitting at home, I travelled the world in a day, talking to clients in different parts of the world. Now, you can't do that forever. You still want to have face-to-face interaction. I'm desperate to to see some of my colleagues in our markets and spend some time with them for a different type of interaction, a more informal interaction.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
How did you make the decision to move to the Bahamas of all the options out there?
We've been looking at the Bahamas for a while. They're one of the first countries to roll out any comprehensive regulation for cryptocurrencies, which we think is extremely important for the space and a really positive sign.
No, talk to me about diversity. So there was a pretty explosive, actually, expose by one of your employees that the media really picked up. Has it changed in any way your thinking?
I mean, I think first and foremost, when that came to our attention, the first thing we did was talk to the individual concerned, understand his concerns and his allegations, and commenced a formal investigation to make sure that we were following up on anything that he raised, and we're in that process. The second thing I'd say, you know, we are absolutely 100% committed to creating a diverse and inclusive culture. You know, you can't be an organisation that operates in 60 countries and not believe in diversity and inclusion. I've remained at this bank for nearly 35 years because I felt as though, as an individual, and we're all different, I felt as though I've worked for people who valued me as an individual. They motivated me, they mentored me, they trained me, they inspired me. If there were times when I was possibly thinking of doing something else, it was when you didn't experience that. So if I enjoyed that and I felt that motivating, then I want that as a leader of this bank for every one of our colleagues. And when somebody says they're not experiencing that, then that hurts, and that's something we've got to address, and I've got to make sure that doesn't happen. So I want a diverse, I want an inclusive organisation, and we will do everything we can to improve. Now, I'm also a realist. I'm not naive. I know there's more we need to do. I know there's more I and my leadership team need to do to make progress on diversity. We've made good progress on gender, but there's more still to do. We've put an awful lot of effort into matters of LGBT. It's clear we haven't done enough for our black colleagues, and they feel as though they haven't had the same opportunities that others. And that's why I set a target that by 2025 I want to double the representation of our black colleagues in our senior leadership ranks. And I want to make further progress on gender diversity. So I've got an agenda that we're working on. I'm committed to it, and I'm not naive to think everything's perfect, and I will make sure that I will keep working on that agenda.
Talking about cryptocurrencies,
yes.
So you were definitely on the very cautious end
yes.
of cryptocurrencies. Has that changed?
No, and let me explain, because it's important to step back.
Yeah.
When I think about cryptos, whatever the form is, I look for two attributes, I look at two dimensions. Firstly, transparency. Secondly, convertibility or volatility. Let me deal with transparency first. Particularly with respect to cryptos, it's important to understand who the counterparties are. And are those counterparties transparent to each other? And are they transparent to the intermediaries like banks and regulators? Because in the world of high expectation on money laundering controls and sanctions control, a lack of transparency can get you into trouble very fast. Second dimension, convertibility or volatility. I look at that from the point of view of, if somebody wants to hold a crypto, what's that cryptocurrency worth? And is that client suitable for that level of volatility? Let me give you an example. If I'm lending money to a corporate and their balance sheet is denominated in US dollars, their sales ledger, their receivables, their cash balances are US dollars, sterling, euros, I'm able to form a reasonable assessment of the value of those assets. Now, if those assets are denominated in a cryptocurrency that can fluctuate plus or minus 10 or 20% in a day or a week, and I've got to make a lending decision, do I lend money to that company? How do I value that balance sheet? So, for me, there are certain types of cryptocurrencies that score highly on transparency and convertibility, and clearly central banked digital currencies score highly on that. There are other types of cryptocurrencies that don't.
Bitcoin.
I'm not going to name any one of them, but I'm looking at it at a theoretical point of view.
Yes.
And then There are certain clients that can cope with volatility, and there are certain clients where I'd have a conduct issue if I encourage them into volatility. So I looked at cryptocurrencies and say it's a phenomenon for the future. It is there. It's happening. So I can't deny it. But equally, I've got to assess the risks and the proposition to clients and different types of clients, and therefore I am more cautious at this point in time because I've got those two lenses that are absolutely critical.
Do clients want them, though?
Yes, of course they do. No, not all clients.
So are you missing out on business?
Yeah, but that's life. You know, at the end of the day, you don't, as a financial institution, you can't chase every piece of business that's going if you don't think it's the right piece of business. Just because a market is evolving in a certain way, you've got to make judgment calls as to which business you'll go for and which business you may not. I firmly believe that central bank digital currencies are going to be there for the future, and I want to be part of that part of the market. I think there are certain forms of stablecoin that equally can exist very well. But I think we've got to see how the market evolves, but I look at those two lenses, and they're important lenses, because if you get either one of those wrong, you've got a conduct issue on client conduct, or you have a credit issue in that you've lent on the back of an asset base that is not real, or you've got a financial crime issue.
So through those two lenses, what needs to change for you to change perspective?
Well, I don't think I'll ever do anything that is involved in a lack of transparency, because you cannot be true to your commitments to regulators to operate a compliant financial crime environment, a compliance environment, if there is a lack of transparency on a transaction. You know, I can't move money around the world, hard currency around the world, without understanding counterparty risk. No international bank can. You put your license at risk. So why would I then do it in cryptocurrencies just because it's an emerging opportunity? Why would I do in the crypto world what I won't do in the real world, in the hard currency world?
Noel Quinn, thank you so much for your time.
Pleasure. Thank you, Nancy.
We are in a debt trap. It's not just fiscal dominance, but when central banks are going to want to essentially phase out unconventional monetary policy, given the debt ratios, there is a risk of a crash in the bond market, in the credit market, in the stock market, in the economy.
We didn't want our story to be ended by Taliban. We wanted to continue the path that we started, to continue to go for our achievements and to go for having our dreams to reality. So that's why we decided to leave Afghanistan and go for somewhere safe. We are concerned that what will happen to our home then. Many people are leaving, but there are still girls who have dreams, there are still people who have dreams, and we want countries around the world to help Afghanistan to have peace over there, so that the girls over there can have the opportunities to continue their path as well.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar
Are we sure about this recovery? From a looming natural gas shortage to slowing Chinese growth to indecision in Washington, you have to start wondering. This is Bloomberg Wall Street Week. I'm David Weston. This week, special contributor Larry Summers on inflation, bond yields, and whether it's all just a blip.
Markets are substantially underestimating what's likely to happen to interest rates before too long.
And what Evergrande could mean for the Chinese economic growth engine and U.S. investors. Investors had their fair share to worry about this week, starting with a dramatic spike in natural gas prices in Europe, putting at risk heat in homes and power in China. Here's Jeff Curry, Goldman Sachs Global Head of Commodity Research.
This is just the first inning of a multi-year, potentially decade-long commodity supercycle,
which only fed the concerns already out there about inflation. Here's Republican Congressman French Hill of Arkansas.
We have addiction to spending in this city. We've had since 1789, but it's on steroids right now, and it's creating inflationary expectations that I think could concern every retired person and every low-income person, because inflation is a thief.
And when we talk inflation, concerns about the Fed tapering its bond purchases cannot be far behind, something Fed Chair Jay Powell put in play last week.
So long as the recovery remains on track, a gradual tapering process that concludes around the middle of next year is likely to be appropriate.
And did nothing to back off of during his testimony this week before the Senate Banking Committee.
Mainly what we've seen is that the supply side restrictions that are so much at the heart of the inflation we're seeing have not only not gotten better, they've actually, in some cases, gotten worse.
But then again, Senator Warren said that if she had her way, it wouldn't be Mr. Powell making the decisions anyway.
Over and over, you have acted to make our banking system less safe, and that makes you a dangerous man.
And if all that weren't enough to set markets off this week, we had the continuing specter of the United States possibly defaulting on its debt as Republicans and Democrats continue to bicker over the debt ceiling, with each side blaming the other. Here's Senators Pat Toomey and Sherrod Brown.
The Democrats have chosen to ignore our warnings about this excessive spending, but they want us to vote to raise the debt ceiling in order to permit the massive spending increases that they're planning.
Senator Kennedy, I rarely speak between witnesses, but I wonder if Secretary Yellen takes you up on the offer to go get a cocktail, if you would pay or you'd skip out on paying the bill and expect Secretary Yellen to pay.
And the markets? Well, it could have been worse. After taking a hit on Tuesday, equities gained some of it back, with the S&P closing the week down just over 2%, while the Nasdaq took the biggest hit, down over 3% for the week. While the 10-year yield, after jumping up on Tuesday, settled down a bit to end the week just under the 1.5 level. While Bitcoin put on a late week surge, closing over 48,000. To help us make some sort of sense out of these markets this week, welcome now Peter Krause. He's chairman and CEO of Aperture Investors. Welcome back. It's great to have you back on Wall Street Week, Peter. So give us a sense of what you think happened this week. Was it all about the 10-year yield?
I think your opening remarks were terrific, but I would say the following. There's a lot of noise out there, so let's focus on the facts. The facts are the Fed has clearly said they're going to taper. The facts are the Fed has said, I'm not going to increase interest rates until well into 22, early 23. Facts are we continue to have growth. Facts are we continue to have elevated inflation, not runaway inflation. So in that sense, it's transitory, but certainly more inflation than we had at 1.5 to 2%. So if you have growth, you have inflation, you have the Fed saying they're going to taper, you have the Fed saying they're not going to increase interest rates, it seems pretty clear to me that long-term rates have to start rising, and they have been. Well, certainly on top of that, the energy prices are reacting, and we have growth. We're not at the point of a recession. So I think if you take away all the noise, it's actually reasonably clear.
Well, but reasonably clear, as a good market to invest in, as a questionable market? Because it seems like if you take this week and last week put together, both weeks, for different reasons, we had big sell-offs in equities and then they come back again. It seems to be very choppy, as they say.
Yeah, I think the equity market, at the level that it's at, is clearly at a value that is getting a little bit high. And I think the equity market's behaving that way. Now, I don't think we're going to see a recession, so I don't think we're going to see a significant pullback. But I've said for the last 6 months to 8 months, this equity market could certainly see a retrenchment of 10 to 15, perhaps even 20% as it reprices itself. The Fed activity over the last number of years has clearly driven interest rates to very low levels. We know real rates in the United States are negative. Real rates in Europe are negative. So what does that mean? That means that all the cash that might have been running after fixed income markets went in the equity markets. So clearly the capital allocation is not normal, and people have more invested in the equity markets than traditionally, and they've driven prices to high levels. So do we have volatility when rates start to move? Absolutely. Would you put cash in the equity market today? You'd probably wait to see for the volatility to reside.
So the question is, if low rates really drive this so much, that does depend critically, does it not, on Jay Powell's statement, this is transitory, it's not permanent. Even this week when he was giving testimony up on the Hill, he said, it's worse than we thought it was and it's more durable. And every time he talks, there's another reason. It was used cars, and now it's natural gas prices. There's always something else. And those supply chain problems are going to linger for a while, aren't they, Peter?
Yeah, I do think they will. I don't like the word transitory because it suggests that the level of inflation that's currently there is going to recede to the level of inflation we had before rates or inflation became, quote unquote, higher. I don't think that's the case. And I actually don't think that's what Powell means. What I think he means is that 4%, 5% inflation is transitory, but not necessarily 2 or 2.5% is transitory. And if we had 2 and 2.5% inflation that was normal and stable, we would definitely have higher rates and capital allocation would take place. And I suspect the equity market would have to reprice that. Look, the Fed is in a tough spot. They've gone from $4 trillion in a balance sheet after 08 to an $8 trillion balance sheet trying to support the economy during COVID. They don't really have a lot of options if they're going to take the balance sheet down. They have to say they're going to taper. That's the only way the balance sheet can come down. They don't want to raise rates now because that could actually hurt the economy's growth. So they've said they're going to raise rates in the future. So I think that's the story. That's where we're going. And the equity market's going to have to adjust to that reality.
Peter, we spent an awful lot of time covering what's going on in Washington, which doesn't make it right. Maybe we're wrong in our judgment about how important it is. But what if the market's priced in, for example, with respect to infrastructure and with respect to this budget, which is $3.5 trillion or maybe $1.5 trillion, if you listen to Joe Manchin this week?
I think the market hasn't priced in any particular action in Washington other than perhaps the bipartisan infrastructure bill. I don't think the market is priced in a debt default. I don't think the market believes a debt default is going to actually occur. If a debt default occurs, that would be a serious consequence.
So when you're looking to put cash to work, you said it might not make a lot of sense in equities right now. Where do you put it?
If you actually have cash and you want to deploy it, I think the question is going to be, what's the long-term objective? If you're putting it somewhere for a short period of time, you should buy short duration securities because they're liquid, they're not going to move that much, and you'll get a better idea of what to do. If you're investing for the next 3 to 5 years, equities is still a good bet. Equities 3 to 5 years from now are going to be higher, and they're going to be higher than whatever you put your money in a bond.
So, Peter, you're such an astute observer of the markets. What is being mispriced by the markets right now, in your judgment?
Well, I think, your lead-in, Larry Summers said that, in fact, the markets are going to be a lot higher, bond markets are going to be a lot higher over time. And I think that investors have gotten used to a Fed who's willing to actually come into the market to stabilize the equity markets and drive real rates to negative levels. And so that's been going on for a period of years. And as a result of that, investors have reacted to it. They've said, I don't want to own bonds, or if I'm going to own bonds, I'm going to own high yield bonds, or I'm going to own long duration bonds. So you have a market that has more money than probably it would normally in long duration securities and high yield securities and in equities. And when you go back to normality, that's going to have an effect. And that's what I mean by capital has been misallocated. because we don't have a normal Fed. This is not a normal time period.
It certainly doesn't feel like a normal one. Thank you so much, Peter Krause. He's going to be staying with us as we take a closer look at inflation and how investors might cope if, in fact, it's here to stay, contrary to what Jay Powell claims. That's next. This is Wall Street Week on Bloomberg.
Who are U.S. Open tennis champion Emma Raducanu's three dream dinner guests?
Daniel Ricciardo, Michael Jordan, and Tom Keane from Bloomberg.
She understands you.
Funny and very understandable.
I am reading in on tennis like nobody.
Yeah. Champion approved Bloomberg surveillance. Mornings on Bloomberg Television and Radio.
This is Bloomberg Wall Street Week. I'm David Weston. There was more talk of inflation this week, with Fed Chair Powell admitting it's a bit worse and more persistent than he'd expected, but still not really something to worry about. And natural gas prices really shot through the roof over in Europe because they have some problems with some supply chains. What if Chair Powell is wrong and real inflation is here to stay after all? What should an investor do? Still with us is Peter Krause of Aperture Investments, and now joining us is Nancy Davis of Quadratic Capital. She is the CIO and founder of that organization. So, Nancy, let's start with you, because you've made something of a name for yourself when I say that in the area of inflation. Without regard to whether you think it really is persistent or not, if it were to be persistent, what should an investor do?
I think every investor needs to be concerned about inflation, especially retirees, because you're not going to benefit from the wage inflation if you're not in the labor force anymore. So we do live in a real world, and inflation is a risk to every investor portfolio because it reduces purchasing power. I think investors just shouldn't be taking a bet on whether it's transitory or not, and really should have, as part of a diversified portfolio, should own some amount of inflation protection.
Well, just to follow up on that, Nancy, what does inflation protection look like? Is that gold? Is that real estate? What is that?
Well, I definitely have a different view about what inflation protection is. I know a lot of investors look at commodities because that worked in the 70s in the last period of hyperinflation. But I think commodities are like the laptop, I'm talking with you on tonight. It's deflationary. Technology has innovated in that space. So I just don't think commodities are the only way to think about how to capture inflation. I personally like using the difference between short and long dated rates as another measure of inflation expectations outside the consumer price index. I think that's a thing that investors have to keep in mind, is that's just one index. It's like if you were to buy equities, nobody would buy just the Dow Jones index and say, oh, I have all equities. I think investors have to be diversified.
Peter, same question to you. If you
I think Nancy makes a really good point about that. First of all, in the commodity inflation time period, we didn't have the same kind of technology boom that we see today. And we didn't have anywhere near these social, I shouldn't say social, but ecologically beneficial ways to actually produce energy. And Nancy's business has really focused on a long-term structural benefit that's out there of taking advantage of the difference between short and long-term rates. And
She called it greenflation because she said, as we make this transition,
time period, we don't know. And if we haven't invested enough in carbon fuels to actually have the supply to get us there, we're going to see price spikes. And we're going to see them actually be very rapid and actually quite disconcerting, because you're not going to be able to increase the supply fast enough to be able to deal with the shortfall.
One of the things, Nancy, clearly we have not invested enough in is supply chains all around the world. I mean, it started with semiconductors, but it's gone well beyond that. Take a look at all the ships lined up outside of Los Angeles and even here in New York. What about that as an effect?
The markets are really expecting a lot of growth. And when you listen to some of the companies as they report earnings this season, a lot of people are talking about the labor market and the delays and the higher costs that are not necessarily growthy costs. They're more potentially a stagflationary costs, where we have higher costs, but not the earnings per share growth.
Peter, as I listen to Nancy, a lot of what she describes is the direct result, I suspect, of the pandemic. We had to shut down the economy and then bring it back up. But is it really the cause of what we're seeing, or did the
supplies out of Japan in a specific place that was near
And that may be just we're trying to get people back online. They're still